All right. It says we are preparing to live stream. So I believe the meeting has started. My name is Brett Schafer. I am joined, as always, by Ryan Henderson, and this is the Chit Chat Money Investing Power Hour, although it is alcohol free. So, we may be misleading people with the name there, but on these episodes, we talk about really whatever we want in investing. Could be investing related, could be philosophy related, could be earnings related, although we're not in earnings season right now. Really anything. Today we got Monster Energy trying to buy Bang Energy out of bankruptcy. Kind of a savvy move there. I think the big topic is going to be the shakeup in the social media landscape with Instagram launching a competitor to Twitter. I have some stuff on Amazon cost cutting on Prime, a Toyota potential electric battery breakthrough, and some other things that we might get to if we have time. But Ryan, how are we feeling today? We're in the lull before the storm of earnings season, and maybe when we resume the banking panic, but TBD on that front.
I know I feel like we've said that for the last month here, so we got to energize listeners. We can't
That's
keep
right.
saying it's a lull.
We do have
some stuff.
This is the most, I will say, this is the most boring time of the year. End of June for investing, beginning of July. There's nothing. No one's doing anything, but I think we have some fun topics today. Try to keep the people entertained.
Yeah, we do. It is kind of, I haven't even checked the portfolio this morning, but it feels a little like everyone's just gotten bored for a little bit.
100%. I mean, we've read this throughout history when we read about kind of the Great Depression or the Roaring 20s. Remember when they would basically go from like 4th of July to Labor Day, the market would just be almost paused, but it would still be open. And then they'd be like, oh, actually, let's start the panic after Labor Day when everyone gets back from summer.
Yeah, I mean, people go outside still, which is good. Yeah, I don't know. It's been okay. I've been less like we've been swamped with more podcast stuff than like investing stuff, I guess, lately. So a little update on us personally. Which has made it so I guess I haven't been as tied into the world of investing, but still keeping eyes on it. And there was something that was pretty interesting this week. I guess it was last week around Monster potentially buying Bang. So I'll launch right into that unless you have anything else you want to say.
Well, the biggest news of the week is that I changed my setup again.
Oh gosh,
we're about 80% there.
I know we had some...
I need a light. I need a light that's better, and then I think we'll be good. But I've changed to the standing desk, so huge update. I think that's what everyone needs to know about.
Yeah, I'm sure the listeners clamor for that update every week. So Monster, which for those that don't know, is the best performing stock since the year 2000 in the US, and it is not close. So, they have just done a phenomenal job. And it's really one where I think studying that business, even if it doesn't provide monster like returns from here on out, is a really good case study for how a simple business can just have remarkable returns on capital.
We did a show on them a couple months ago, so go check that out.
And it's also one that maybe I think demonstrates how tough it is or how tough it can be to be a buy and hold type investor. There were the guy that had won the Value Investors Club best write-up of the year or whatever, which is I think was a little more prestigious back then. Maybe it's still pretty prestigious. Wrote a short report on Monster in 2006. And it was pretty convincing. And if you read it, you're like, yeah, that makes a lot of sense.
It worked, right? In the short run, at least. For a year or so. I think it was.
I don't know.
I'll look up the stock chart to see if he actually made good returns.
Well, you might want to double check the date too on that write-up, because it might not have been exactly 2006, but it's easy to look back on that and say like, oh, what a fool. But he was a really good investor and he had a lot of winners other than that. So I don't know. It just, I guess it's really kind of mind-boggling how big Monster has gotten during this time. Anyway, so last week they announced that they might be buying Bang Energy, and For reference, 10 months ago, Monster sued the owners of Bang Energy, which is the parent company is called Vital Pharmaceuticals. By the way, I recommend looking up a picture of the Bang Energy CEO. It's exactly
Well,
what you think he'd look like.
I heard
The
that he also wouldn't give up ownership to the Instagram. Did you see that?
No,
He apparently will not give up the login account to the Bang Instagram. I think he he used to enjoy putting photos on there with certain individuals with he was an interesting guy. Let's just put it like that.
yeah. Anyway, so they sued Vital Pharmaceuticals, owner of Bang Energy, over false advertising claims, and they won. Monster was awarded $293 million shortly after Vital Pharmaceuticals, parent company of Bang Energy, filed for Chapter 11 bankruptcy. I thought that was the end of Bang Energy. Last week, however, it was announced that Monster is now trying to buy Bang Energy out of bankruptcy for $362 million. Originally, they were waiting for approval from the FTC, but 3 days ago, the FTC announced that they were terminating their merger review process early, basically saying, we don't see any problems here. So it looks like the deal is going to go through. For reference, Bang has an estimated market share still of about 3%, anywhere from 3 to 5%. Monster has north of 30%. So, and Red Bull is still technically the largest, I believe, in the US. And so if you combine Bang plus Monster plus what's the other one they have under their Rain? I think Rain and one other.
I can't
NOS.
remember. NOS, yeah.
I think they become the largest. They become the market leader after this. For reference, so they're buying them for $362 million. Bang Energy had an estimated private market valuation of, now this is estimated based on, I think it was like Axios or someone just basically took their market share versus Celsius's and said, if you apply the same multiple, that kind of thing, it would be a private market valuation of $10 billion last year. So Monster is buying Bang for pennies on the dollar, really. And
Well,
if you believe that, no, I mean, it could be poorly run or whatever, but if you just lock it into Monster's distribution system, I think you've probably got a really well-run business. And it's still 3% to 5% market share. I mean, that in the energy drink category, that run properly can be worth well north of $360 million.
yeah, might not be 10 billion, or at least not anytime soon, because Celsius, there's some ardent fans, I guess, of the stock. It's at a premium valuation, and really that's because it's done so well. But
yeah, I mean, it's earned it for sure. I'm a Celsius fan now. I'm an addict.
Oh boy. How many a day? One a day?
It depends on my coffee intake. I'm still a coffee first, but if I limit my coffee, if I don't have that much, I'll drink a Celsius before a workout later in the day.
We got to check your heart rate during the show, Ryan. That's a lot of coffee and Celsius. That's a lot of
right here. I know I should probably limit my caffeine intake, but here we are. So these shows, they're tiresome. It's can't be going all day without the caffeine.
Yeah, recording a podcast. Well, I mean, I'm standing up now, so it's basically a workout. True. I mean, Monster Energy, look, time and time again, they're just run really well. There's not really much to discuss with them because they buy assets in the energy drink space or anything kind of adjacent that they try to explore sometimes. When the price is right, they have a good model, for they just run a very simple marketing playbook and they put it into the distribution, which again is actually, I think a lot of the times Coca-Cola's distribution, if I'm remembering our research correctly. And then the energy drink category grows. They adapt to new things, with sugar-free and stuff like that. And they raise prices along with inflation and they print money. It's a pretty simple model. It's very similar to soda, as people are probably well aware. I think the CPG food space, especially, along with tobacco plus food, or let's widen it out, nicotine plus food in the CPG space is a very attractive place to hunt for stocks. A lot of these stocks typically trade at like 30 times earnings, but I think they're ones you want to keep on the watch list. And when, depending on each situation is different, when it gets to an attractive price, then yeah, it's one of those where it's really, really hard to lose money if you buy at the right price.
Yeah, I look at Monster and every time I think, wow, it's a really good, it's a really good case study of how you could have gotten good returns, but that's all in the past now.
Yeah,
I wonder if I
100%.
would have said that in 2012, 10 years ago, and the returns have been great. And I mean, I think they still have room to expand the product. They have room to add new products and really expand the category as a whole. I'm wondering if I'm going to be kicking myself in 2030 for saying the same thing, where it's like, oh yeah, it's run its course. It's at saturation. Because I mean, they still grow volumes. Deals like this, it might not seem that big initially, but if they can sort of reinvigorate the Bang crowd, because Bang was, in some ways, it kind of felt like Celsius before Celsius.
Without the health stuff, yeah, but it was exciting, a little viral. They had some, like I said before, interesting social media posting strategies to attract the target demographic of these drinks, which is young males.
Yeah, and there was,
and it worked. It worked really well.
Yeah, it wasn't quite as, I guess, health centric as Celsius tries to advertise, but the whole like creatine label, which was ended up being false, I think ended up making people think it was like healthy or like a good workout drink, even though it's just pure caffeine. I don't know. I mean, I wonder if Monster is kind of one where you just stick in your coffee can portfolio and don't look for a while.
Yeah, I mean, we go back and forth on this, right? I think from our point of view, at least our strategy, and again, strategies evolve. It's one where you put on the watch list and you wait for that small moment where either the overall market's crashing or whatever, where it actually starts trading at a cheap price. Because again, we learn, if you didn't learn this over the last 3 years, you need to have a margin of safety on price. All right, we have some comments here. Firm Return says, evening, gentlemen. He's in the UK. I should note that we went on his podcast, which is very fun. It's called Firm Returns. He does a great newsletter as well. It's free, covering some really niche stuff. If anyone enjoys that, we covered Nintendo on that podcast. Go check it out. Then we have a fun question from, this is a good name, Mr. Dapper Capper. Great name. So whoever had that. What are your thoughts on consolidation in the media industry? What are your thoughts on the risk return of Paramount Global as it is selling off non-core assets, potentially in preparation for a sale? Yeah, I mean, that one's interesting. It seems like someone will buy it out for a higher price, maybe than today. Buffett was in this one. I think he might still be. So it's interesting for sure, but the risk is that left on its own, Paramount probably dies, right, Ryan? Like they're not in a good.
I haven't really looked at it enough, to be honest, but I just don't like anyone that's having to kind of reinvent themselves in the streaming world, or
100%.
I'm not a fan of companies that have to make the transition from linear to streaming, because the subscribers are fickle and churn is substantially higher than you got with the cable operators. So,
and Apple and Amazon don't care about economics.
Yeah, and you're competing with a totally different set of competitors.
And YouTube grows share every year, so your pie is shrinking versus competitors like YouTube. The only one I would buy at the right price, and I came to this conclusion now, which unfortunately, we both have basically come to this conclusion, I think, which we came to this conclusion a year ago, is Netflix is just better than everyone at executing, at their strategy, at understanding how this business works. And the price probably doesn't make much sense to me today from a buying perspective, but look, how are you gonna? That's the only one I would buy, but obviously at the right price. Don't
Yeah, I
bang your head
agree.
against the wall with these things. Like,
I
right?
know.
Like,
I mean, you can see like the kind of impact it has on a company like Disney.
100%.
It's really, I don't know. It's just
For when looking at me,
there are easier investments to make.
yeah, okay. For example, we don't own it anymore. We have followed very close and we have owned it for a long time. The one I compare, and we do this comparison when looking at any media type thing, is would I rather own this stock, say this like Paramount Global, or would I rather own Electronic Arts, which is not high growth,
We don't own
but
it anymore, by the way.
that's what I said. Yeah, we don't own it anymore. But we still like the business. I would love to own it at the right price. If like the moat there is so much better than a lot of these companies. They generate cash every year, and I don't like that's my hurdle rate for those businesses. Like I would much rather go hunting in the video game space than these media companies, or than the video entertainment companies. What do you think?
I mean, I don't love anyone that's trying to compete on streaming that's kind of subscale. Basically, anything other than Netflix. YouTube's different, but anything other than Netflix, I don't really want to try to figure that out because, like I said, it feels like uncertain. There's investments where I think you can get a similar return, but there's not as much risk of the failing to adopt users. With video games, I used to think, yeah, I just want to own the great publishers. But I'm starting to feel over the last few years that we've been investing in video games, the one thing I've learned is it's hard to invest in video games because they're very unpredictable. And maybe not on necessarily
Except EA.
well, I don't know. If I told you in 2019 that FIFA, their largest franchise, is going to grow 10% at least every year for the next 4 years, and in the final year it's going to grow 30% bookings, and cash flow is going to be down for the overall business, I would have been very surprised. But those AAA titles, talent is so expensive, it's becoming harder. I mean, it's becoming more competitive because there are, I think the building blocks for indie developers are making it so that, other companies can compete for time spent. You don't need the big, huge developer teams. Now, if you want to build a huge title like, Battlefield or Call of Duty or FIFA, yeah, it's going to be costly, but you're competing for time spent, not necessarily on a single game. So and maybe that's just been bad management from EA or bad cost management, but it feels like it's becoming more and more costly to maintain your position in the video game space.
Yeah, but I also say that you could flip that and say it insulates people from the competition, where none of the big tech companies they've all tried to make games and none of them have had success organically, which I think is a great sign that there are moats here. But yes, it does come down to, well, the moat can be strong, but at what price of the future cash flow are we paying? It might have been lower than we thought.
I guess my
4x could
point
also
is like,
be,
yes, okay.
4x could be affecting that in a short run, but it is obviously a concern. A lot of the cash flow of these businesses haven't compounded at the rate that the same rate as bookings. There has been some margin compression.
The other thing is, okay, yes, it's really hard to compete with FIFA for the FIFA users
or all these games. I mean, none. We're not talking sports titles that these people, but yeah, FIFA, obviously. Sure.
Yeah, but you're still competing with mobile titles. You're still competing with anywhere else that people spend their time. Really, if there's less, even especially in a live services world, if they're spending less time on your game, you're probably going to have less bookings. So,
Roblox.
And I think even though it takes tons and tons of talent to build a game that's comparable to any of those huge titles, you can build a Fall Guys quickly, or you can build Fortnite probably took some complexity. What's the other one with like the cars and the soccer ball.
Rocket League.
Rocket League. These are like, I think that was Epic Games, but there's indie titles, there's indie developers that can now compete a lot more effectively for time spent where they maybe wouldn't have been able to 10 years ago.
Yeah. Yeah, somewhat. But I mean, time spent on across all the publishers seems to be growing, at least over the long term. Maybe not Activision Blizzard, as they've had some struggles, but EA always highlights that time spent is growing.
Well, it's a bummer that cash flow isn't.
Ryan hates that. So Ryan is so peeved at EA management.
I mean, it's insane. It's honestly insane. Cash flow's down over the last 4 years, and their major titles are much bigger. Like,
yeah, and it's not, they're not
and their CEO gets paid 30 million a year to do that.
Yeah, and they're not investing that much more into R&D, which again, R&D is just game development. R&D is up, but a lot of it is these SG&A expenses, which probably can be,
or it's acquired. Like they acquired R&D headcount through the mobile acquisitions or random acquisitions, but
yeah,
I don't know. They started doing layoffs. 6% layoff in March. Maybe there's something.
Yeah, I think they maybe realized that. I think it was classic. I mean, we've talked about it constantly for the last year. A lot of these companies realized that they overhired and they didn't realize it until they overhired for maybe like a full year. And that really hurt margins across the board. And speaking of which, overhiring, that happened at Meta as well. So why don't you talk about this next topic, Ryan?
Yeah, this is fun. I titled it Zuck versus Musk cage match heating up, but it's not the actual cage match. So there was some talk, I guess, about them having a wrestling match, which I thought was kind of hilarious, but I don't think anything's come of it yet. However, the real cage match is Facebook versus Twitter. So for those that don't know, last week, Twitter, more likely Elon Musk, introduced some new rules that non-verified users can only look at 600 tweets a day. Verified users can look at 6,000. 600 tweets. If you spend a lot of time on Twitter, you can pile through 600 tweets pretty quick.
I'm going to say bragging. Haven't hit my threshold. So
I haven't, but I imagine there are some days when I would have.
You would have. Yeah, me too.
It was apparently meant to prevent data scraping. So I guess something, and I'm not as familiar with this side of things, but apparently they have like some API that they tried to raise prices on, and then to avoid like some of the companies that were using the API to avoid it, or the generative AI companies that were trying to scrape data off Twitter by just looking over a bunch of different tweets. That's kind of the data scraping process, and they wanted to limit that, or they wanted to push people to use the API or whatever, which they raised the price on by limiting the amount of tweets someone can like look at in a day. However, it kind of, in my opinion, ruins the experience a little bit for like just the normal user. What were your thoughts?
People get upset. Yeah, for sure.
What were your thoughts when you saw this announcement?
Well, I got to be honest, it was 4th of July weekend. And what was this, on Saturday? I don't know. I was prepping something. I honestly didn't see it until like Monday. So, but when I saw it, yeah, I mean, it's a poor business decision for sure. They mentioned that it wouldn't affect the financials that much, or like advertisers there wouldn't be that many less advertising impressions, but you're really angering your users, which I don't think is smart, right? And especially right when, as you're about to lead into, Instagram's going to launch a competitor right when your core power users are getting angry at you.
Well, something I found is all the other changes that have been made to Twitter since Elon stepped in haven't really affected me that much. Like, it hasn't really changed my habits on Twitter. This one actually did, because now I'm spending a little less time, because I don't want to go on there and like,
you're worried about hitting the threshold.
yeah, hit my threshold, then a whole bunch of stuff comes up later on. I can't look at it, or I got to subscribe or whatever. And it just feels like like I don't want to waste it right now. And so it's actually like it's limited the time that I've been on there now. And I think maybe so it's actually changed my actions, and I'm just like a normal user. I imagine some other people are in a similar boat where it's like they don't really want to hit the threshold. Maybe it's prohibiting them from wanting to hop on and spend as much time on there. Facebook comes out this week and says they've announced a new product called Threads. It says Threads offers a new separate space for real-time updates and public conversations. Posts can be up to 500 characters long and include links, photos, and videos up to 5 minutes in length. Basically, it's very much a direct competitor to Twitter. Now, the bummer here is that you have to sign in with an Instagram account, which I kind of wish they didn't do that. So if you don't have an Instagram, you have to make one.
Oh, we hate that. We hate,
yeah, that kind of
let's
pisses
get
me
those
off, to be
let's get
honest.
those MAU numbers up. Right. That's literally the only reason I did this is to get juice user numbers. I mean,
Yeah,
that
it's
has
honestly a little frustrating just as someone that, like, if you're trying to capture the Twitter audience,
there's a lot of
you probably want to pick the people that aren't, that you probably want to make it accessible to the people that aren't on Instagram.
100%. And yeah, Twitter and Reddit are kind of in a similar boat where there's a lot of anonymous accounts. And I made again, we talk about this all the time for social stuff and any sort of media stuff, where the relationship George thing from Seinfeld explains so much of it. You have to separate your social, whatever, social George, which is Twitter and Reddit, and a lot of these anonymous accounts, versus the relationship George, which would be Instagram, the thing you put on for your family and friends.
Apparently, Facebook was planning to launch this later, but because of Twitter's recent move, they expedited that process and shipped the product a little earlier. It's only a mobile app right now.
Really?
Do you think? Yeah, I looked online. I kind of all it is just a QR code to download it on your phone.
They know how to juice engagement. God, these guys are good. They're good.
Do you think that moving this process forward, speeding it up, and I guess launching this product was a good move for Facebook?
I think so, for sure. They're good. They're good at getting people to engage with these things. They know how to diabolically get you stuck on these things. So yes, I would look. This is okay. Two things I think I was thinking about as I saw your notes here. Maybe we'll hit this one first. Okay. Twitter has never been run optimally. I read the business biography on Twitter up until I think it was published in like 2014, 2015. It was run terribly up until then, and it still got a bunch of users. Dorsey ran it while he was high on. Okay, we don't need to say anything. He was high on life. Obviously, it's he's an interesting guy, and he didn't seem to be really focused on improving things that mattered. He was just focused on Bitcoin. Musk buys it, and we've all seen what happens in the last couple of months here. Obviously not optimal, although the notes feature seems great, unless he makes his own notes about Tesla products, which I find frustrating. So I think this type of app, which is the global communications, written communications as its base, easily has a chance to be much bigger. Why is it in as big as an Instagram, with over 1 billion users? I don't understand why. And it seems like it's because the ownership of Twitter has been so poor. The app doesn't work very well. I mean, it constantly doesn't work as well as any of the other big tech stuff. So yeah, I think that. What do you think on that? And then I have another question or a topic I'd want to discuss regarding Twitter's moat.
Yeah, I mean, I've thought kind of all along, like, how do you monetize it properly? It's not really a great platform for ads, in my opinion. So I don't think you can run it.
Zuck's going to take that challenge and shove it right down your throat, though.
Probably. Maybe that's why they're trying to integrate it with Instagram, which feels like a really good platform for it. And frankly, the Threads is like kind of weirdly intermingled with Instagram in some ways. But
yeah, we gotta stop that. We gotta stop. We gotta stop that.
I've always thought there was room for a subscription if you were able to add value in some ways. Maybe it's like a news bundle for Twitter or something. And he's been trying that with the subscription products,
That's a
the
good. We did it.
verification.
Yeah, we did it for the CCM account.
But with verification, you don't really get that much like added functionality. You get the ability to edit tweets. You can put some stuff in bold font.
Apparently you get promoted to more people to follow you, which I guess technically we've seen an uptick. So, but that's something that's very hard to quantify. I mean, you get to edit tweets for like 30 seconds and then come back and maybe do it, but that's really not that useful. I find it annoying, honestly, that it waits 30 seconds to publish. I just hit the send now thing. I mean, yeah, the value there is not very strong, but there could be a subscription offering for sure, but I doubt Meta will do that.
Yeah. I don't know. I mean, I think Twitter's botched it. I don't think Elon's really done that well. I'm pretty sure the business is smaller than it was before he was there. So on a revenue basis.
Yeah.
It feels like everything he's done has been to basically reduce costs, restructure the cost base. And a lot of that was, I think it was like 70% of the staff was laid off. They're not paying their Google Cloud bills. I think they weren't paying rent for a while.
Google came in and kind of said, "Hey, they're paying now apparently." But,
oh, all right. And now they've apparently this was to prevent having to pay for server space for a bunch of generative AI companies.
I get that. Though. I get that part.
That makes sense. But I don't know. It's like it kind of ruins the experience for normal users. So
yeah, well,
it's a tough business to run. He probably shouldn't have acquired it. I think he's got a whole bunch of debt holders that may end up owning the company here at some point.
Yeah, you have a question here that says, could this be the final nail in the coffin in Twitter? That comes up with my second discussion question here, which is, I would actually flip that around. And if Twitter, as mismanaged as it is, survives this moat test from the best social media company in the world, then I think this thing is never going to die unless it literally gets run so poorly that it just actually dies.
Yeah, I mean, I still go to Twitter. It's still got I think the one reason I keep going back the most is it's got the network effect. There's so many users that are already there that it's the place I want to be. It's where we kind of have a literal network there where that's where we find guests. And when we use it all the time, I keep coming back, even if the platform gets worse and worse. I have to keep coming back. So I think, yeah, they do still have a moat. Maybe there's the chance that honestly, this incentivizes me to pay. And I've always I think just because it was free and now Twitter's charging potentially to essentially use the app a lot, people are going to be upset. But it's no different than like old school media publications, which is functionally what Twitter kind of is today. It's just real-time news. Should you? Yeah. I'm not opposed to having to pay for that kind of thing.
Yeah, I was even thinking of paying for our personal accounts, like pitching that. I mean, had it on the back burner. Like, it seems like it provides enough value for us. We're in a little bit of a unique situation because it is one of our biggest distribution areas, the biggest distribution area for our top of funnel. It'll be interesting to see what happens. I think we need to revisit this in a couple of months because there's always the Twitter competitors that hop on. We talked about Substack Notes. I got caught in the hype there. Nah, not going to do it. Let's see how big Twitter or Instagram threads are.
Maybe Elon knows what he's doing. Maybe this is a business that's impossible to kill.
I think it might be. Here's the thing. They'd be generating good amount of cash if he didn't alienate all the advertisers with this weird conspiracy theory stuff that he does. Right? Am I crazy?
Nah, I think you're right. We do have an interesting question here in the chat.
You see that one? Okay, yeah. I was going to hit that.
It says, do you still feel confident in your investment in Spotify over the major music labels after your discussion with Sleepwell Capital? How do you think through that analysis? You want to take this?
Sure, yeah. I mean, it's a complicated industry. There's a lot of variables that are at play, but I'd say nothing has changed. And in fact, this is one where Spotify's, let's say, leverage as it grows is only going to grow over the labels each year. So as its users grow, as its engagement grows, is only going to grow each year. And the relationship with the labels is much, much better than it has been in the past. They are currently, I can say this with confidence, just reading through the tea leaves of what Eck has said on conference calls and on Twitter. They are negotiating for better take rates on their price increases, which is why they haven't raised prices yet, as they're kind of probably finalizing those negotiations with all the labels. They're adding on a ton of new valuable stuff. I mean, you've probably seen this, Ryan, as a Spotify user as well. They keep putting those concert stuff, the ticket stuff, the merch stuff in much more better places, which is a way for these artists to earn a lot more money. I mean, they're providing way, way more value to the artists these days than, well, maybe not more than the labels, but the value Spotify provides to the artists compared to 5 years ago is much higher and should grow over the next 5 years. So that part of the dynamic of the Spotify business is not a concern for me. I'm curious to hear your thoughts. There are concerns, which is basically wasting money on deals with Meghan Markle. But what are your thoughts?
I do still feel confident that Spotify will be a more important business in the music industry over the next 5 to 10 years. And I think it'll actually expand the music industry the way it has been over the last 5 to 10 years. I would also say that I don't really think about the investment in Spotify as, should I own Spotify or the labels? Spotify is going to grow the entire music pie, and streaming generally is going to grow the entire music pie. They finally surpassed their 2001 highs, I believe, in terms of industry music revenue.
Not inflation adjusted, but yeah, nominally.
So yes, I'm still confident that the business is sound and that the platform will be more important in 5 to 10 years. However, I mean, I'm a little less excited on the investment side than I was maybe 3 or 4 months ago, just because the stock's up 100% in like the last year to date. So
although the business has shown they've had some really strong quarterly performance, but obviously, 100%.
There is some stuff. Price. Don't get me wrong. There's some stuff that pisses me off about the management team. Maybe they just saw it as an investment period. They went full force into it and wasted a lot of money. But I guess that one of the things that irritates me is they always brag about, or one of the recent quarterly letters, they're like, we've generated cash flow for each of the last 3 years.
Yeah, it's negligible. And yeah, I mean, at least they're not.
And it's down if you include stock-based compensation.
Yeah.
Like SBC is just growing, and they're like, yeah,
right.
Cash flow has been flat for the last 3 years. I'm like, that's awesome. Okay.
Also, they have a working capital advantage. Now, I think the working capital advantage is not something to scoff at, but that is a reason they generate cash. And it's also a reason, probably my biggest low light for the labels. Well, maybe not the biggest, because there is that existential risk of the democratization of music distribution. But the labels they have a working capital disadvantage because Spotify holds the funds for 90 days. I do like that because it gives Spotify a lot more optionality to invest. It's not a huge part of the business, but yeah, that cash flow stuff they brag about is annoying. But yeah, in the music stuff, I don't think anything has really changed. And in fact, it should steadily rule in Spotify's favor as they continue growing, especially here's what's interesting. They're not going to make that much money on these emerging markets compared to North America. Say like in India, they get 200 million users or 300 million users if they really execute well over the next 5 years, something like that. I mean, they're not going to be worth nearly as much as the 50 to 70 million users that are in the United States. But to the artists who are going to do a tour in India and get 3 or 4 live shows, I mean, that's an incredible amount of value for growing your global brand. So I think the value they provide artists is only going to grow. And really the way to track that is just, are they continuing to grow subscribers? And are they continuing to grow their total user base?
Another comment basically around Spotify's place in the competitive landscape. It says, kids use YouTube, not Spotify. Kids have YouTube accounts. Free Spotify is horrible. There are a lot of people that don't like Spotify. I get that, but
they've said that for the last 5 years and they just grow. So
I mean, it's been Apple's given away Apple Music basically for free. YouTube basically giving away YouTube Music for free. Amazon Music basically giving away Amazon Music for free, or at least at a huge discount to what Spotify offers. And now Spotify is over 500 million users versus like 150 million users 4 or 5 years ago. So the business just continues to grow. I used to care a lot more about the competitive set, but Spotify, they have a playbook for attracting users and converting them to subscribers, and it works really well. So no, I'm not too concerned about that. He also asked,
YouTube is the big, I mean, YouTube is the one competitor to watch though.
Yeah, I guess own Google too. Do you think Nintendo is trading at or below fair value?
I would say, yeah. I would reference you to one, either that episode we did with Firm Returns, who again, if you're still on, thanks for joining. We covered Nintendo there. We also did, if you look back through our feed, we did a show on Nintendo. What was it? 3 months ago, maybe 2 months ago. I would really talk about that. We do still own it. Full disclosure. Like we can't just say buy something because it's undervalued. Now I'd really look at our analysis on that. We have a write-up again on the Substack as well. So look at that. And we give all the risks in that as well. Because I really hate saying, look, I think it's undervalued for blank, blank, blank. Because there are risks of these things. And we always want to cover those as well. But yeah, I mean, look at the show. Look at our holdings page. Yeah, we own it.
I mean, there is.
And the stock, I guess, is up a little bit. So
yeah. And I said own Google too. Not actually. I mean, we own it. So not investment advice, but I will say, I mean, YouTube probably not going to have the hugest, like the biggest impact on Google's stock overall. A lot of good comments in here. People saying they love the podcast. Yeah, love that episode. I think Spotify has a lot of leverage to pull, and it's not necessarily winner take all. If you're on Spotify, I've been on Spotify for 5 years. Churns just continued to shrink and shrink for Spotify. The pie is growing overall. YouTube can continue to expand, and I mean, it's not explicitly a music offering. YouTube Premium also provides the ad-free videos, which I think is a really compelling value proposition.
And they provide YouTube Music for free, basically, on top of YouTube Premium.
And so, I mean, I think that is a pretty formidable competitor, if you want to call them that. But Spotify has grown in the face of that since YouTube Premium has been offered. So
we got a comment from Firm Returns. Still use Spotify for podcasts, which I think does help when they consolidated that. It really helps for the distribution perspective because YouTube is still more of like a discovery thing, which is great. But for your actual feed of shows you follow, Spotify is a lot more helpful and cleaner. He says, still use Spotify for podcasts, just not sure they've made any money from me. Well, I know you listen to our show, so you made a tiny bit amount, but on their automated ad network, just for full disclosure for anyone that wants some anecdotal evidence from us, we use them on some of our episodes. We'll probably use it for this one. It's a great little backup plan. But if you look at the rates they pay us and the impressions they get versus our listens and versus how many ads we put per episode, which I think is 4, we only get ads on about 10 to 20% of the actual slots that we have. So there's a ton of room for improvement there, and they need to make more progress.
Yeah, I don't think a lot of people understand necessarily the creator tools that Spotify provides. It's kind of, especially, I mean, most people look at it as the consumer facing product, but they do really provide a lot of value to both podcast creators and even artists as well.
100%. So. Yeah, that's the only gripe I would really have, right? Is that, like, look, versus the ad slots that we give them, they don't fill it nearly as much as we would like.
They're still doing a hell of a lot better than Apple Podcasts, though, because
that is 100%.
Apple Podcasts hasn't changed in 10 years. So
yeah, that is 100%. Yeah, I mean, it's really a YouTube versus Spotify race, and the people that started in podcasts, maybe if you started listening to podcasts, 7 years ago, you probably used Apple because Spotify didn't have podcasts at that point. But anyone new, is anyone new to listening to podcasts going to go to Spotify or going to go to Apple? I doubt it. And what's funny is that so many people use Apple devices. So it's interesting how YouTube and Spotify just totally out executed them.
I mean, Apple Podcast still gets their fair share of listens just because of the valuable real estate. It says I've never heard an ad listening to your podcast on Spotify. That is
there we go. That is yeah.
I don't think it's rolled out though to the UK.
Or only maybe a couple European markets. So yeah, see, look, there's there's a lot. So let's hit another topic. We can't talk about this all day. We got 15 minutes left. I'm sure people get bored of this. I know it's interesting, but why don't we hit?
What about this Amazon cost cutting?
Okay, you want to do that?
Yeah.
Good news. Yeah, if anyone is interested in following the media stuff, which I know one of the people listening right now is, I would definitely follow. You don't need a Bloomberg subscription for this. A little hack is that a lot of their newsletters are actually free. Follow Lucas Shaw on Twitter. He's their media guy. Look at the Screen Time newsletter. Get it every Sunday, or this week I think it was after the 4th of July. But this week he had a tweet. I don't need to share it. He said basically Amazon CEO, which is Andy Jassy, asked the Hollywood studio to provide detailed analysis of budgets for some of its most expensive projects. In the newsletter, he writes about growing scrutiny on this stuff. Let's see if there's any fun fact here. Okay, so look, here's kind of the thing. He says that basically Amazon spends a lot on shows similar to how someone might spend at a Netflix or a HBO, but they do not get nearly the engagement as Netflix. So, for example, The Peripheral, Daisy Jones and Six, Dead Ringers, and The Power, which, have you heard of any of these, Ryan?
No.
I haven't heard of them either. They all cost each over $100 million to produce, and they only collectively charted in the Nielsen top 10 in the United States for 2 weeks. And essentially the Nielsen top 10 is dominated by Netflix. So it seems like Amazon needs to realize that their strategy cannot just be to copy Netflix and HBO here. They need to go a different route, maybe more sports, maybe more, live stuff, cheaper stuff. Someone said they just need to turn themselves into the CBS of streaming, a lot of football, some filler shows, and realize they're that and they're not HBO.
It is a little concerning, honestly, that Jassy's like, hey, looks like you're losing us hundreds of millions of dollars. Just checked. Do you mind explaining why? Were you unaware of this?
Here, to be fair, when he took over, there's a lot of divisions. So
still, I mean, come on, like, if you've got $100 million cash incinerator, I know Amazon's big, but you might want to take a look at it and be like, is it worth the spend, right?
Yeah, 100%.
And I get that it's a very complicated job, and you have a lot of departments, but it is your job. And I don't know, this kind of doesn't, the headline does not put Jassy in a great light.
Yeah,
I mean, it's better that he's doing this than not doing it. But
look, I think it puts him in a good light because no one has talked about this until he got there, because he ran the only division at Amazon that's consistently profitable, Amazon Web Services. I think he's looking at these other divisions like, hey, like, I ran this thing with a lot of employees and it still made money. Why can't we make money at these other places? Oh, wait, we're wasting a bunch of money on this Astro robot. Like, come on. But it's hard. The thing is, they've talked a lot of big game on that, but the actual, it's been a lot of bark, no bite on the cost cutting, right?
Yeah, I mean, they have done a number of layoffs. It just, I wonder if there's anything here where it's like Bezos's baby he wanted the influence. He wanted to be a part of that kind of group of people, of Hollywood stars.
Oh yeah,
And
and they explicitly
Jassy
talk about
feels
that.
like he
Yeah,
can't necessarily just like cut it off.
yeah, they explicitly mentioned that in the second Amazon business biography that covers like the 2013 to 20, say, kind of middle of the pandemic period. They explicitly said that people worried that that's all that Bezos was looking for. So maybe they do get worried about that, but I would hope eventually Jassy will, back up all this talk about rationalizing costs. And there's always these quotes in these articles about the VP of the studio praised the teams for a good job, and it's like, well, you're no, you did. That's just a lie. That's just frankly a lie. It's strange.
Yeah, I don't know if it's a distribution problem or a content problem. My thought is it is not a distribution issue because Prime Video has tons of people that watch it
It's
or
basically
that
free. I
have the
mean,
app. So
I
it's
think of it as free because I'm not really, because I'm paying for delivery.
everyone knew what the Rings of Power was
Yeah,
because
it's
they
just
ran a bazillion ads, but
it was not very good.
I think it was a content issue. I think you're right that the right decision to move this studio forward is to go CBS of smart TVs. See,
Yeah,
you know, content, sports rights, stuff like that. I mean, they do a good job with Thursday Night Football.
yeah. People don't like that because it's like at the bars and stuff. They got to really figure that out for the live audiences. But yeah,
Oh
all right.
gosh, MLS is a nightmare with Apple TV. I don't know if it's a single bar that has it.
That's right. Like you can't watch it anywhere except your actual house, right?
Yeah, it's miserable, but whatever.
Yeah. Well, that happens with Friday Night Baseball for the local team. When it's on Apple TV Plus, people are like,
Yeah, baseball's all
yo,
time bad.
yeah. Okay. What about, we got a couple minutes left. Do you want to hit here's one that a chart. Let me just share it with you so you can see these charts. It's about the booze economy. It's quite interesting. Okay. Sharing is loading. First one we got here. America's brewery boom. This is from Derek Thompson. Great follow on Twitter. Maybe we'll be saying threads soon. The number of breweries in the US from 1976 to 2021. This is a chart. 1976, there was only 103. Then there was a boom in the 90s. I find it funny that these both booms of these coincide with stock market bubbles. And then there's a kind of flatlined. And then the last few years, it's boomed to over 9,000. Here's another chart. Total number of distilleries, basically the same thing. Since 2001, it's boomed to over close to 1,500. Employment and all these is up a lot. Employment in distilleries. So, okay. The big takeaway is that there are more niche things out there, or basically more investment in premium beer, wine, spirits in general. And that means like drinking is actually going down. So it seems like the premiumization of alcohol is going up. I think that's actually bodes well as that being another investment category to target. What do you think? Kind of toss that into the CPG brands because those can be very, very. I mean, I'm guessing you earn fantastic margins on these things if it's
You think
sold at the
so?
right if sold at the right price. I mean, not the wineries, people. That's different, but like a good brand and spirits can be
I
extremely
worry that
profitable.
yeah, but I also worry that this makes the alcohol category kind of uninvestable for public investors because most of the companies that are available are big beer manufacturers where
Oh
it's like,
yeah.
the Sam Adams, the Anheuser-Busch, they own a lot of, I think they've started to buy up craft breweries. And I bet the economics on a single craft brewer, if it's successful, is probably pretty good, but it means less people are probably attracted to the light beers, right?
The what beers?
The light beers, like the
This shows that it's. I mean, there wouldn't be tenfold in distilleries and breweries if it was just going to more lighter beers. Like
I'm saying like more people are moving towards these like craft brewers.
Oh, okay. I thought you said the opposite. Okay. Yeah.
So I don't know. Doesn't it kind of make it harder to invest in this as a public market investor?
Well, I would guess, yeah, not for those ones, but these premium brands that could be, compounders and see steady growth and have really strong pricing power, especially in the spirits category. I guess maybe they're not actually too many that are public, but seems like an interesting investment idea.
No, it feels like if craft brewery is becoming more and more competitive every year, we've seen the growth in the different craft brewers. We're in Seattle, and there's an absurd amount of just.
I think that's
brewers.
Everywhere. I mean, it's everywhere. I mean, look at that chart.
Doesn't it kind of drive you away from this area? Doesn't it kind of make you not want to be there as an investor?
Well, maybe not the breweries, but I'm saying if you have a good brand in spirits is probably number one. Wine's tough because a lot of people just do it as pet projects, but beer is probably in the middle there. If you have a good brand, I mean, it's no different than the Monster Energy space. I mean, energy drinks are hyper competitive, but when that good brand takes hold and has a good marketing strategy and has good pricing power because people attach to it, then I think there's opportunity. I mean, there's been some really, really good growth in spirits from some certain brands, which I think is super interesting. Now, Diageo, or however you pronounce that, seems to be buying Diageo. Yeah, I never could say that right. Seems to buy up a lot of these things, and maybe that's the way to invest in it. But I think spirits is quite interesting because, again, it's not winner takes all, but there's lots of pricing power in premium spirits.
Yeah, I guess I could be off here. My thought here is the overall number of people consuming alcohol or alcohol consumption is declining.
Yeah, right? But the premiumization, that's what these charts show. Premiumization is going up. So people are they're drinking less, but they're willing to pay more for when they actually have them.
Interesting.
Because there's no way that employment would fourfold.
All because of that Bud Light ad.
No, I mean, that just helped Modelo, but that's interesting. Modelo's, I guess, number one, if anyone doesn't know. We have a final question here. Thoughts on Alibaba and China overall? I can answer those quickly. We don't invest in China.
Even more so now.
Yeah, I mean, it gets worse every year. I mean, we like to play, we hope, simpler games. Doesn't mean we're going to make money than harder games. I think investing in China is just bashing your head against the wall. There's 100 other countries I can invest in that have better rules of law.
I mean, that was, I think, one of our early investing takes that ended up aging well. We had maybe a few, but we had a lot that aged poorly, but that one I thought aged well. We thought it was too complicated. We thought there were some rules that made it tough to be an investor. We avoided it, and I think we've been better off because of it.
Yeah, it's just they're going to look cheap. It's just
the China discount doesn't turn into a China premium. That's not it's not a discount if it always trades at a discount.
Do you think they're going to be more favorable to businesses? In what world does that?
Remember that DCF we saw where it was like, I did my new Alibaba DCF and it was like cash flow every single year. And then it was like fee paid to China government, all of their cash flow.
Yeah. Oh yeah.
You can just get fined or just pay it all back because it's, everything you earn is for the government. It makes it kind of tough.
Yeah. Or they have the right to do whatever they want. But yeah, okay. Here's the best stat that I think just shows it. The stock market returns for the Shanghai index have been really bad. It's like up 50% since the 90s versus the S&P 500 total return of like 1,000% cumulative. But China's GDP has grown at a much better rate than their stock market returns. That either tells you, one, that they're lying about their GDP numbers, which there's a lot of evidence they are, or two, the domestic product, the production of society, is not going to the business owners. Why would I invest in a society where this, as a stockholder, You want a place that favors business owners, and
it
rightly
may
or
have-
wrongly,
Yeah,
rightly
it
or
may-
wrongly, the U.S. favors business owners. So
It may have benefited society. That's more of like a political question.
that's personal,
But-
yeah. But as an investor,
But we are investing. We are public company investors who have not been rewarded. Why should that change?
yep. All right. Well, that's a great way to end it. Thank you everyone for tuning in. Some fantastic questions today. And you can listen to these basically for the few people that tune in live. You can watch the replays on YouTube or listen on Sunday mornings on your favorite podcast player of choice. We are not financial advisors. Anything we say on this show is not formal advice or a recommendation. We are general partners at Arch Capital, and clients may hold securities discussed in this podcast. Thank you, everyone, again, and we'll see you next week.